Good morning, everyone. It's 8:01 a.m. Chicago time on the 11th of April, 2018. Thanks for joining me. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Risk off overnight on the news flowing in and what seems like a Twitter war. Regarding the U.S. involvement in Syria, the Russians are threatening that they would take some strong actions if the U.S. takes action and its coalition take action in Syria. And President Trump is saying that they're going to come flying anyway, regardless of the threat. So what this is showing is there's an imminent action. There was movement recorded. I follow a service on Twitter that talks about military movement and so on. There was quite a bit of movement going on in the Mediterranean. And so it looks like it's something that is coming to fruition. So the market's pricing that in. The S&P dropped to 2626 overnight, an important area that we've dealt with over the last 2 to 3 weeks. But overall, risk off. The DAX is lagging today, down 1%, 117 points. And the leader today is gold as money moves into safety. Gold's popped up $10.50, trading at $13.5660. So that's how things are shaping up. We see allocation is to safety. The bonds are up. Crude oil's up, of course. If you have issues in that area of the world, you're likely to see a supply disruption of some sort. So crude is higher. So overall, we're having another day where we're seeing a potential gap down. We're trading right near yesterday's, the prior day's low. And it's in an area that's difficult to plan for somewhat because we have been trending up. I'll cover that in a minute. We have been trending up, and that's being interrupted now by this news here. Again, a news-driven market could do anything, right? We could sit here and do scenario 1, 2, 3, 4, 5, 6, 10, 15, 20. It doesn't matter if the market has to price in an imminent threat to risk, and so. Again, you have to be, and this market has had wide rotations, so it's got a fair amount of volatility. I mean, a day like yesterday seemed like it was a kind of a non-event day, but it's 31 points of range. Those who were around a year ago or so, maybe not a year, summer of 2016, let's say July. I mean, we had 9-point ranges, 10-point ranges. 12 points is like, wow, we had a 12-point range. So we're covering quite a bit of ground. And on Monday, we went from 2610 to 2653, so 43 points. So overall, the point is, this is the kind of market where you don't want to sit there and be stubborn because you can give up a month or more in just one trade that you just cannot let go of. So it's paramount that traders stick with their plan. Yes, your trade was correct. Yes, it ended up hitting its target ultimately, but it breached your risk parameters. Let it go. Look for the next trade. And just remember, this is really important. Just remember, every trade stands on its own. Every trade stands on its own. And what does that mean? It means that the last trade, whether it worked or didn't, has no impact on the series of trades that follow. It does not. By itself, if a machine was trading it, it does not. It is a single sample in a large uh, data set that is independent. So the factors that went into this trade are completely different and cannot be the same because it's an open-ended sample set, data set. It's completely independent of the prior trade. So if you sit there and go and tell yourself, hey, I've had a series of strong winners, so let me get more aggressive now, without having a plan to mitigate the risk or manage the risk of that extra size that you're putting on, simply based on the fact that you've had some good trades. And I've seen this, by the way, I've seen this thousands of times where traders get confident with a 2 lot, and then they go to 3, and then all of a sudden they're trading 12 lots, and then they just completely implode. You know, they had a good set of weeks or a couple of months. They've made a lot of money in that time, and then they're limit down on their account very quickly. So you have to understand that each trade stands on its own. It stands on its own merits, and the outcome of that trade stands on its own. So you can't connect things, although our brain is designed to connect things, connect a pattern, and explain what's happening today based on what's happened before. You have to take each trade on its own merits and look at it as it's a single card draw, right? If you're drawing cards from a deck and you're putting the card back and shuffling it, it doesn't mean that you can't pull that card again. It doesn't mean that you may not pull that card again, even if you go through the number of cards on the entire deck. These are important things to understand as a trader, and it leads you to one conclusion, and that is just control your risk, let the market do the rest. Control your risk. And you can't do that by getting emotional or holding on to a trade that did not work. You got to let go of that last trade so you have an opportunity at a brand new trade with its brand new parameters, so you can capture the next move if you're in alignment with the market. Anyway, I won't preach on that any longer, but it's just really important for me to say that. It's something I've said to my prop traders continuously over the years. It's just you got to let go of that last trade. It's really not making you or breaking you to do that. Here's what I expected, the scenarios that were set up for yesterday. The way we were set up, we were gapping up 26.4850 versus a close of 26.18 or so. Notice that Monday was a complete. It's not a technical doji setup, but notice that Monday closed right where it opened. So the market explored up, the market explored down, went neutral, and closed at the open. So what that told us on Monday is that it was just completely unable to hold on to the value prices up top around 26.45, and it ended up selling off. And of course, that happened on news. And the market ended up going neutral after a trend day up. Very unusual, as I said yesterday. Now we come back in yesterday morning, and we have a gap up 26.4850 on comments from the Chinese president or prime minister, and the market's responding well. The auction from Monday afternoon before the sell-off resumes, we go back to continuing that auction. And so the expectation, given that if you eliminated, say, if we eliminated all the news pieces, this plan here, just so you have an idea of how I'm coming up with this plan here is simply a continuation of what would have happened had that news not occurred. Okay, that's the expectation. So we're just eliminating this part because the market's gapping up and taking that back. It's back at the scene of the crime of the SOC. And so the auction continues. The auction was interrupted by this news and it fell. And now it came all the way back. So what do we look at? We look at, okay, if that news did not happen and we attach this what is likely to happen? It's likely to pull back, continue higher, right? We would have a continuation move on the move that we had on Monday morning before the sell-off. And so that was the key plan. I was looking for 2672 yesterday for a test, and that would have taken us into the prior weekly high, which is quite bullish. And if we got there, I was looking for 2676 as the extended target. And I narrated a trade on Convergent that covered that. But it didn't quite get there. It actually turned very fast on news. It was, you can't help but get frustrated with the fact that it's just the market's not able to flow under its own power. I welcome the volatility, but it's hard to trade volatility if it has no basis in that it's just being constantly interrupted. The secondary scenario was to push up into this this really important day here last Thursday, consolidation day, balance day, to push right into that to that day, 2661 quarter, and then to fail and then resume the Monday afternoon trade if the buyers are not aggressive. Okay, this is what actually happened. Very noisy trade. Let me just clear this up. Wow, there's a huge lag here. So let's kill the stock zones. So this is what actually happened. We did end up drifting down into the low volume node, and we ended up with an impulse up, right? So this is what we were looking for on scenario 1. Drift down and an impulse up. So that was played out perfectly. Played out perfectly, and we ended up getting into that 61 quarter area right here. But then we had, again, more chatter, news, Russia, FBI, whatever. And it just went neutral. Again, we have another neutral day. So we ended up with the neutral day yesterday after a trend a day up. We broke the IB. This had all of the trimmings, all the pieces for a decent rally to 72, 76. I was very confident that that's where we're headed. And then we just got two pieces of input into the market that caused us to go neutral. Once we went neutral, and this is the issue with news, and that's why we keep track of this thing called the SOC, the scene of the crime, where the auction gets interrupted. Let's say it's a trend day up. Okay, it's trending, and then news comes out. Oh, explosion at some area. And then it just drops. What happens is the market immediately goes to safety. Risk is taken off the table. Close, sell. And then we assess. So the market is very, very good at shoot first and then ask questions later. Very good at that perspective. And so when we ask questions later, we find out it's pretty benign, and then we see this as a decent price to now reestablish a position, maybe even get a better price, and it starts to drift up. And then what happens is it comes back to that price where the market was interrupted, and that's called the scene of the crime. And then the auction, it's almost like this part here, once it reattaches, once it regains, this part here almost gets erased. And then you just go by what was happening in the auction before then, and then predict as best as you can what it's likely to do next. And that's what happened here. We went right back up to where the auction was interrupted, and then we continued higher. The 66 quarter was right up against, 2 ticks against the value area high of last Thursday, which was a balance day and that's the template day for the day. I call that a template day, meaning it's the day that I'm referring to find out what happened the last time we were up here. And so that was 66.75, and it's on the it's a stock zone for today. You can see here 66.25 shows up, and it covers all the way up into that value area high. So I'm watching that area. As far as what happened overnight, wrong key combination. As far as what happened overnight, here's what went on. We had earlier comments in Asia, taking back some of the Chinese comments regarding trade, and then the market just consolidated, didn't do much, and then at about 5 o'clock, we started to get this back and forth on Syria and the escalation of military action into Syria, and we get this quick drop of about 15 points initially, and then the market continues to drift down for another 5 points. So we dropped from, in this situation, we dropped from an SOC, of about 42 half is the SOC of this news, and we got to 26.26. And so overall, the profile in the overnight session is saying the market is struggling to find value and has left us with a double distribution. With a double distribution into the low, the important thing to note is look at how the market is dealing with volume. As the market is dropping and prices are falling, it is lifting. Okay? It is lifting the offer. As the market is dropping, the offer is being lifted. There's some buying going on the drop. And so it's interesting to note. So to me, there's not much we could do with that right now because it is in the aftermarket. We don't that this could simply be a hedge against an option position or whatever. Lifting in a future futures basically being used for what they were created for, which is to hedge positions. This could be a hedge on the way down against other positions, but it's important to note that this is what's happening. We have a clear low volume node here at 2637.50. It is the initial line in the sand this morning. I want to see how the market reacts here. The volume is pretty good, 274,000 versus 110 to 120,000, which is what we would consider to be normal. And we are below mid, below VWAP, and we're trading at the point of control currently. And so this is where we stand on the overnight session. News driven, not very clear as far as what's next. So as we look at what we've done over the last few days, note the profile I have set up here, the microcomposite. The microcomposite's thin on the bottom and it's heavy at the top. This is basically a P-shaped profile on the multiple days I have it on. I started it on Thursday with the top that was created. Even if I included Wednesday, it would still be a P-shaped profile with the point of control 2650, 650, which is where we were, which is basically yesterday's point of control. The market moved back yesterday over the last couple of days. Monday, Tuesday, moved back into balance higher, into this balance higher, and the market's attracted to these prices up here, between 2650 and 2670, and keeps getting interrupted temporarily before it comes back up. This morning, we're opening right against the low, 2635 of yesterday. So the expectation this morning is that we're likely to reject lower prices. I'm expecting that if there's any movement lower, it'll probably result in some sort of rejection, and I'm expecting the market to respond higher and move back into yesterday's range. I'm looking for the point of control to be re-tagged at 5650 relatively quickly this morning for a consolidation, and I'm looking for yesterday's auction to resume. So overall, my bias this morning coming in is long. Does that mean I'm going to buy anything and everything as the market opens? It does not. It does not. It's simply, I simply see evidence that the market is not able to sustain, to accept lower prices once the shock subsides. It's very, very quick to buy back. We saw that yesterday. Yesterday after the news, we saw it the day before, and so on. Ultimately, this trade war stuff is just drama and theater. It's reality TV, in my opinion. And so, I don't believe that that it'll have a lasting impact on the market. But overall, I expect the market to push higher this morning. Now, if it doesn't, and this is the Monty Hall problem, you should look that up, Monty Hall. The Monty Hall problem, in that if it does not respond this morning to the buy side, I'm going to be an aggressive short, okay? So if it pushes in and is not able to hold prices higher, I'm going to be an aggressive short, and I'm looking for a test of the open gap below. That's the initial test. And then I'm looking for it to retest this 2610 area for a bounce into the close. That's scenario 2. Why would I be very confident in the short if it does not reclaim? Because the way it's been trading, everything has been skewed to the high side, right? So we're accepting value higher. There's one point of control to the next, these red lines. There's the next point of control higher. We're accepting higher and higher and higher value. And so the overall market participation is better to the long side so far. And if that fails, we're going to find a lot of people needing to liquidate. My expectation is it'll be relatively aggressive, pushing down. Now, again, we could talk about this till we're blue in the face of news flow. Anything goes. So it could blow. It could play both scenario 1, 2, and 3. It could play 1 and then crash. It could rally 50 points. Who knows? It's just a function of what the leadership, global leadership, is doing currently. So, just with that being said, just understand that your job is to identify an edge in a statistical probability as much as possible. Put on the trade with the risk parameters that you can live with, and then let the market do its job. Currently, the S&P, if you're trading it, currently the S&P has a harmonic rotation of 3.75 points. Your stops have to be wide. Your stops have to be wide. If you don't have enough money in your account for a stop that's fairly sizable, 3-4 points, you're going to have to be very, very picky and live with the fact that you may just, bleed slowly until the volatility calms down. It's just a wide, it's a fairly wide range that we're trading in, and fairly volatile. So that's all I have for you. Good luck, and I'll catch you tomorrow. Take care. Sorry about the long video. Take care.